All right, folks, this is the second of our three-part video series on pullbacks. And the first video, I wanted to explain the problem. And again, the problem is a lot of traders find it difficult to identify the right long-term trend, the right pullback, whether it's pulled back long enough, whether there's enough elasticity for it to pull back, or it's a reversal. So it's difficult for a lot of traders, especially beginners, to trade pullbacks. So I explained that in order to trade pullbacks, you need to have the long-term trend, the short-term trend, and you need to know whether the pullback is far enough. So that's what I'm going to do in today's video, but I'm going to do it objectively. So again, this is the second video of our three-part video series on trading pullbacks, and let's get into the screen right now. And I'm going to show this with you with Amazon. So we need two studies. The first study is the moving average envelope. Excuse me, exponential moving average, not the envelope. I made a mistake there. It's been a long day. I thought it said exponential moving average, but it said envelope. So yes, we need the moving average exponential, and we set it on 20 days, all right? We're swing trading. We need a very short-term period, 20 days. That's the red line you see right here. It's a 20-day exponential moving average. And the difference between a regular moving average and an exponential moving average, the exponential moving average puts more weight on more recent data. So it's faster. It reacts faster for swing traders, okay? We need one more indicator. We need the relative strength index. And we need it, not usually, when you put this indicator on, you'll see it set to 14 days. I like to set it to 10 days, all right? So now you have the exponential moving average right here. And now you have the RSI. And the RSI, when you see it right here in the blue line, that means the stock or the asset, and you can apply the RSI to any asset, it's overbought. And when you see this little red dot, it's below the red line, below the 30 line, it means that the asset is oversold. And again, the beauty of this is you don't have to use your eyes. You can simply use these tools. These are technical tools. They're completely objective, and it'll give us a good idea of where to enter and exit. So here's the rules, and the rules are really simple. I'll give you the rules, and then I'll get into the third video, and I'll do a few examples. So the rules are the market, or whatever. When I say the market, it could be a stock, an ETF, a currency, a commodity. It doesn't make any difference, as long as it has volatility and liquidity. So we need the asset to trade above the 20-day moving average. Then we need the asset to trade below the 20-day moving average. Once you see it trade below the 20-day moving average, and before it had to trade above, so it has to trade above, then it has to trade below, that means it's pulling back. We have to see this little diamond, this little triangle right here. This is the RSI telling us that the asset is oversold. All right, let me draw this so you can get a better idea of it here. See this little thing right here? That right there is where we enter, right here. So you wait for the oversold bar, which is right here. It's that bar. And then you would enter, let me just clean this up for you here. You would enter this right here. And the question is, where would you exit? Well, that's great. You would exit right here. You would exit right there where the stock is overbought. So you enter when it's oversold, and you exit when it's overbought. It's real simple. And in the third video, I'll do a few examples to show you again how we would trade this. But it's really simple, it's really straightforward, and I'll do a few more exercises in the next video. And again, as far as studies, you're using the exponential 20-day moving average and the 10-day RSI. I'll see you guys in the next video.